Okay, let's jump right into this because today we are unpacking a massive global financial shift that has literally been making headlines across the entire financial world. The core of our explainer today is focused on one really profound development. China just stopped buying US debt, and we're going to explore exactly why this could be incredibly bullish for gold. We're investigating whether the world's second largest economy is quietly, and I mean very strategically, engineering a global gold shock by dumping US treasuries and pivoting toward hard physical assets. So we'll be looking at the raw data, the geopolitical maneuvering, and the actual nuts and bolts of the precious metals market to understand exactly what is happening beneath the surface of the global economy. We're going to kick off our investigation with a highly provocative claim about the true hidden price of gold. Financial analyst Jay Martin recently stated something that really caught my eye. He said, "I think that July 24th is the day that China starts finding out what gold is actually worth." Now, you might be wondering, what's so special about July 24th? Well, this quote is in direct response to a massive policy shift within China's domestic banking sector. Specifically, a strict ban on retail paper gold trading that went into full effect in the summer of 2026. But to truly wrap our heads around why this domestic banking policy matters so much to the global price of gold and why experts are pointing to this specific date like it's ground zero, we actually have to zoom out first and look at the broader macroeconomic chessboard. Section 1. Dumping the dollar. So to understand the motive behind this massive gold pivot, we first need to look at the raw numbers surrounding China's relationship with the US dollar. For decades, the standard economic playbook was honestly pretty simple. China exported manufactured goods to the United States, they earned billions in US dollars, and then they recycled those exact same dollars right back into the US economy by purchasing treasury bonds. This arrangement was a win-win for a long time. It helped fund US government spending, and it kept the Chinese yuan artificially weak, which was absolutely crucial to boost their export competitiveness. But recently, that long-standing playbook has been completely thrown out the window. Just look at the steep drop here mapping China's holdings of US treasuries. From holding well over $1.3 trillion in US debt around 2013, we can see this incredibly steep, steady decline. Their holdings fell to a near two-decade low of roughly $683 billion by late 2025. What we're looking at is a massive capital flight from US treasuries. President Xi Jinping has openly called for the renminbi to become a global reserve currency, and they are aiming to build a multipolar financial order that just isn't so reliant on the US dollar. By reducing their exposure to American debt, Beijing is actively seeking to avoid potential losses from volatile US interest rates, while also insulating itself from the increasingly strained, unpredictable trade relations between the two superpowers. But it's not just that they're selling. It's the sheer speed of this transition that has completely caught the attention of global markets. I mean, official data from the US Treasury Department revealed that China rapidly reduced its holdings by over $100 billion in just the single year leading up to March 2023 alone. $100 billion in a single year. And they didn't stop there. They followed that up by offloading close to another $50 billion in just the first quarter of 2024. These aren't slow, gradual adjustments. These are massive, rapid-fire reductions in U.S. debt holdings, and they fueled intense speculation across the financial sector. Naturally, the immediate question everyone is asking is Beijing purposefully dumping U.S. debt as some form of economic warfare? Let's look at Section 2, the custodial nuance. Before we jump to conclusions and assume this is some purely aggressive financial attack against the United States, the data actually builds a much more nuanced picture. Because, in the complex world of global finance, things are rarely as simple as they appear on the surface, and we always want to impartially report the facts as presented by economic analysts. So the crucial takeaway here is that while the official top-line holdings of U.S. Treasuries are undeniably down, impartial experts point out a vital distinction between outright divestment and strategic asset reallocation. Analysts from Leo Wealth and the Council on Foreign Relations highlight that China might actually just be shifting its funds into proxy custodians. Think of it like this. It's like moving your money from a giant public bank account with your name on it into a series of smaller, anonymous safety deposit boxes in places like Belgium and Luxembourg. These European clearinghouses have seen massive influxes of treasuries, which U.S. data simply logs generically under other countries. Plus, Beijing is well known to manage a vast network of shadow reserves outside of its central bank. So instead of entirely abandoning the dollar, they are also reallocating funds into other U.S. dollar-denominated assets like mortgage-backed securities and U.S. agency bonds. These offer slightly different risk and yield profiles, but they're still tied to the dollar. Furthermore, we really must impartially report that a total aggressive dumping of all U.S. debt would actually be economically self-defeating for China right now.
Let's think about the mechanics for a second. If China suddenly flooded the market with nearly $700 billion of U.S. treasuries, it would instantly depress the price of those bonds. That means China would literally be destroying the value of its own remaining portfolio. Secondly, and perhaps more importantly for their daily economy, selling off all those dollars to buy yuan would drastically strengthen the Chinese currency. China's economy still relies heavily on an export-led growth model. They actually registered a record-high trade surplus of $1.2 trillion in 2025. A massively strong yuan would make Chinese goods far too expensive for the rest of the world to buy, devastating their export competitiveness at a time when their domestic economy is already facing some real growth challenges. Therefore, the sell-off we're seeing is a gradual, strategic rotation. It is definitely not a chaotic dump.
Section 3. Killing paper gold. Now, here is where the real plot twist in our explainer happens. We have to look at what China is doing concurrently within its own domestic gold market. Because they are rotating out of U.S. paper debt, sure, but they aren't just holding cash. They are moving into tangible physical assets. And they are fundamentally changing how their citizens are allowed to interact with the world's oldest safe haven asset. Notice this hard deadline right here, July 24, 2026. On this specific day, major Chinese banks, including the Industrial and Commercial Bank of China, which, by the way, is the world's largest bank by assets, they literally pulled the plug on all retail paper gold trades linked to the Shanghai Gold Exchange. Other massive institutions like the Postal Savings Bank of China and China Construction Bank completely followed suit. They sent out notices advising all their retail clients to close their positions, liquidate their holdings, or take physical delivery of the gold before the deadline. After this date passed, online and mobile access to paper gold trading was entirely 100% shut off for everyday retail investors. This is absolutely massive. This crucial policy shift draws a thick line in the sand, forcing citizens away from leveraged paper trading and pushing them directly into physical bullion ownership. Now, the official explanation from the banks at the time was risk mitigation, protecting retail investors from the wild price swings and heavy margin calls that are often associated with leveraged paper products. But the practical outcome of this rule is profound. By curbing speculative paper trades, the government is essentially telling its citizens, look, if you want to invest in gold, you need to buy the actual physical metal. You need to hold the bullion in your hand. It channels all that immense domestic demand directly toward the physical commodity itself, rather than a digitized synthetic derivative of it. And this brings us right back to financial analyst Jay Martin. He notes that while risk mitigation is definitely a convenient excuse for the banks, the real goal here is far more strategic. Think about it like this. Imagine 10 people all holding a ticket for the exact same seat at a concert. That's essentially the paper gold market. As he explains, if there are 10 paper claims for every real ounce of gold, the market sees 10 times more gold than actually exists. Western exchanges like the COMEX and the LBMA heavily utilize this kind of leverage, where multiple paper claims can exist for a single physical ounce of gold sitting quietly in a vault somewhere. By removing this inflated, synthetic supply from their own domestic market, China is actively calling the bluff on Western paper markets. They know that massive amounts of paper leverage artificially inflate global supply, and when supply looks inflated, it inherently suppresses the spot price of the metal. Ultimately, this shift is entirely about forcing a return to natural price discovery. When you strip away the synthetic manipulation of paper derivatives, where massive institutions can just create gold contracts out of thin air to absorb buying pressure, you finally anchor the trade in reality. You are left with a market value based purely on actual physical supply and the real, tangible demand to hold those physical ounces. A lot of analysts compare this moment to the 1968 London gold pool crisis. Back then, artificial price pegs completely collapsed the absolute moment physical demand overwhelmed the paper promises. By anchoring the Shanghai Gold Exchange purely in physical delivery, China is aiming to grant its own exchange much more credibility and trust than the heavily leveraged Western exchanges.
Let's move to Section 4, the BRICS strategy.
Now, as you might have guessed, China isn't acting alone in this pivot toward physical assets. This isn't just an isolated Chinese banking regulation. It is part of a much larger, coordinated macroeconomic strategy heavily involving the BRICS nations, that's Brazil, Russia, India, China, and South Africa, alongside all their newly expanded members. The BRICS nations are rapidly acquiring gold for 3 deeply strategic reasons. First up, gold offers absolute protection against Western sanctions. It's a bearer asset, meaning it sits completely outside the SWIFT financial messaging network and literally cannot be frozen by foreign governments if it's in your own vault. Second, these nations are actively developing central bank digital currencies, or CBDCs, like China's ECNY and Brazil's DREX. Using physical gold to partially back these digital currencies lends them immediate global credibility and insulates them from the inflation of base money. And finally, gold serves as a vital long-term hedge against the depreciation of the US dollar, with some economic projections suggesting the dollar's share of global reserves could fall to as low as 40% by 2035. Hoarding gold is a direct, calculated play to build a robust, multipolar financial network that is completely immune to US monetary policy.
If you want to know what kicked this specific trend into overdrive, look no further than this massive catalyst right here. In 2022, following the invasion of Ukraine, the United States and its European allies seized approximately $300 billion in Russian foreign reserves and excluded major Russian banks from the SWIFT system. Now, regardless of the politics surrounding the war, from a purely financial perspective, this action sent absolute shockwaves through the global banking sector. It served as a glaring, undeniable warning to any nation outside the G7 that relying on the US dollar and Western financial infrastructure carries massive existential geopolitical risk. It proved once and for all that fiat reserves held in foreign banks are really only yours until the host country decides they aren't. Gold stored in your own sovereign vaults, however, is completely immune to this risk.
As a direct result of that massive geopolitical wake-up call, global central banks went on an unprecedented buying spree. According to the World Gold Council, central banks purchased a staggering 1,136 tons of gold in 2024 alone. To put that massive number into perspective, that is roughly the weight of 16 space shuttles. It's the second highest annual purchasing volume ever recorded in history. The average annual purchases by central banks over the last 4 years have literally doubled the average from the preceding decade. And China has been leading the pack the entire time, consistently adding massive tonnage to its sovereign reserves month after month, publicly signaling a profound loss of trust in the traditional fiat system.
Which brings us to Section 5, the bullish case.
So let's bring all these macroeconomic clues together to reveal the ultimate impact on the global precious metals market. We have China slowly, strategically backing away from US debt. We have central banks globally hoarding physical bullion at record paces to avoid sanctions. And we have domestic Chinese banking regulations actively killing the speculative paper gold trade. So, bringing it all together into a perfect storm. Step 1, you halt retail paper trades, entirely cutting off the avenue for infinite synthetic supply. Step 2, you incentivize your massive domestic population and your central bank to pivot aggressively toward actual physical bullion. Step 3, by demanding real delivery rather than paper promises, you fundamentally strain the available global physical supply. When an economic superpower like China actively abandons the leveraged paper markets, it causes a massive structural shift. Because if investors who are forced to close their paper positions decide they still want exposure to gold, which many do, they now have to buy physical bars, coins, or physically backed ETFs. This creates an environment where true supply and demand mechanics finally take over.
And what is the real-world result of that structural shift? Well, driven by relentless physical demand from the East and a massive flight from fiat currencies, the price of gold surged to an astonishing all-time record high of $5,400 per ounce by February of 2026. This isn't just a temporary spike driven by some short-term panic. Experts argue this is a fundamental repricing of the asset as it moves away from Western paper manipulation and toward Eastern physical accumulation. Basically, when the paper bluff is called, the true scarcity of the physical metal is finally accurately reflected in its price. All of this leaves us with one final, profound question to consider regarding the future stability of the entire global monetary system. Is China intentionally engineering a global gold shock that will permanently redefine the US dollar's dominance? Whether it is a deliberate, coordinated attack on the dollar or simply a prudent self-preservation strategy to protect their massive wealth from inflation and geopolitical sanctions, honestly, the outcome is exactly the same. The fundamental rules of global reserve assets are being rewritten right in front of us, moving away from paper promises and returning to tangible hard assets.
If you found this explainer helpful and enjoyed diving into the data with me today, please hit that like button, make sure to subscribe to the channel so you don't miss our upcoming deep dives, and most importantly, leave a comment below telling us exactly which complex macroeconomic topics you'd want me to unpack next. Your feedback absolutely drives this show. Thanks so much for watching and keep learning.